We're joined now by Dr. James Libby, an associate professor and chairman of the Department of Business Administration at Thomas College. Jim, thanks for being with us today.
You're welcome, Pat.
What do you make of these kinds of big swings in the market? Huge losses Friday and Monday, more than 500 and then 600 points. Today, up more than 400 points. Is there a rational reason for this, or is it just emotion and fear?
No, it's very rational. I think the markets behave rationally, so when there's a lot of unknown, you're going to see bigger swings. You're going to see volatility indexes shoot up. You're going to see changes in the markets like we've seen the last 2 days.
We heard that the Main State Retirement Fund managers are saying we don't change our investment strategy because of this. We know there are hills and valleys. Is that the approach that the average investor with a 401k ought to be taking?
Well, the average investor maybe. I think there were a lot of people out today, though, trying to take advantage of the low prices in the markets. I mean, when you get a stock like KeyBank, for example, that hovers around 9 normally, and all of a sudden it's in the 6s, hey, it's time to buy. You buy low, sell high. A lot of people still do that in the market.
So it's essentially a lot of stocks are on sale right now. These are companies that are still healthy, so you figure, well, all right, they're probably going to bounce back, if not tomorrow, then sometime soon.
Well, they're healthy. I don't think it's quite that easy, though. A lot of this is still repercussions from the housing market. I mean, the government took on more debt as a result of the bailouts, and because they had to take on more debt, the credit rating was affected. Now that the credit rating's affected, we have new dynamics. And so with those new dynamics, I think you have to really step back and assess what will the fallout be. And I know some towns and municipalities are finding that out because their credit ratings will change.
Now, what needs to change fundamentally for investors to feel calm again?
Well, I think sometimes we don't put enough emphasis in the United States in terms of policy on the savings rate. I think people still need to go back to the old basics and save. Savings equals investment, so you're talking about putting money in the markets. If you put money in the markets, you should see prices rise. The problem is there's not a lot of disposable income out there in the markets, and that's a problem across the nation. And now you're seeing, as a result of that, some pretty unusual policy out of the Federal Reserve.
Now, a lot of people in tough times, when they're worried, they turn to precious metals, and especially to gold. Is it too late to get into that because that is so high compared to what it was just a couple of years ago?
No, I think you'll see another 10% increase in the price of gold, and I think you're going to see the dollar continue to drop. And I think that maybe something we need to take a look at is the free fall of the dollar. People are obviously moving to gold because they feel it's a safe haven.
All right, Jim Libby, thank you. We're going to talk to you some more at 6 o'clock and
yes,
get more at the root of all of these things. We appreciate you being with us.
This is News Center at 6.
One person watching all of this economic volatility closely is Dr. James Libby. He's an associate professor and chairman of the Department of Business Administration at Thomas College in Waterville. You're also a former lawmaker, so you understand a lot of the policy making that goes into this. First of all, do we need to blame Congress for the position we're in right now? Senator Snowe certainly not dodging the responsibility at their failure to reach what people see as a comprehensive deal.
Well, I think there's a lot of blame to go around. I don't know that I blame Congress directly, although I think they deserve some of it. You've seen Congress come out with policies in the past that on housing, for example, that I feel have led us into this crisis. And because of that, we've taken on an awful lot of debt. You've heard earlier tonight, $5 trillion more in debt in recent years makes it really difficult for us to pay our bills.
That's an important point. I mean, the trigger for the volatility of the last few days was the Standard & Poor downgrading U.S. debt. Ultimately, how important is that? Is it just an embarrassment or is it something deeper?
Well, it's important because it will reverberate throughout the economy, and rates will increase. Despite what you heard earlier tonight, the Fed will be able to keep the federal funds rate low, but other rates, the prime rate, for example, you may see move up because of what's happened. There's been an introduction of a new dynamic, and it's risk.
Does it have to be all of the credit rating agencies, or is it enough for just one to say you're downgraded now, it's going to cost you more for credit?
Well, one is a new dynamic. I was surprised. I think a lot of people were because people still flood into United States markets. They still buy our bonds. I think a lot of people were caught a little bit flat-footed on this one, but there have been changes. It's been a long time coming, and so now we're going to see some more.
Now, what's your sense of the person who has a retirement account, a 401k or other market-based retirement fund? What should they be doing when things are fluctuating the way they are now?
Well, I think they're frustrated with their leadership. There's no doubt about it. They're frustrated with Washington. They're frustrated with Augusta. And sometimes they lash out and they don't know really how to deal with it. And, you know, when a situation is like that, I think the most important thing to do is step back. Don't get involved as an investor. Don't sell low. You'll end up buying high. You won't make the kind of good decisions that an investor should make.
And what's the approach the state should be taking to try to make sure we minimize the impact?
Well, I think they are. I think the current administration is really focused on that particular aspect, the amount of debt, the money that's coming from Washington, the fact that there'll be, you know, more kind of shortfalls as a result of changes in money coming from the national level.
All right, Jim Libby from Thomas College, thanks so much for sharing your expertise with us. We'll talk to you again soon.
Okay.